So, Netflix just dropped what, on paper, looked like a fantastic quarter, a real blowout, and yet the stock immediately tanked. So, what did Wall Street see that maybe the rest of us missed? As a long term investor, I have to understand if this is a real warning sign or maybe, just maybe, a buying opportunity. So, let's roll up our sleeves and dig into the numbers.
And this right here is the big puzzle we're trying to solve today. On the surface, everything looked great, but the market's reaction was swift and brutal, a 9% drop. So did the market sniff out some hidden weakness? Or did it just, overreact, creating a potential opening for us? That's the question we're going to answer. All right, let's start by looking at that earnings report itself. Because, like I said, if you just read the headlines, the numbers looked absolutely stellar. Okay, first up, let's talk about the top line. That's the total amount of money the company brought in. It was over $12 billion. That's a jump of more than 16% from last year, and it beat what the analysts were expecting. Growth was solid everywhere, from North America to Asia. So far, so good, right? But this is where you gotta read the fine print. The net income, the profit, looks huge at first glance, but a massive chunk of that, $2.8 billion, came from a one-time breakup fee from a failed deal. And look, this isn't profit they're going to make again next quarter. Any seasoned investor knows you have to strip these one-off events out to see the real, underlying health of the business. So here's the crucial thing you have to remember about the stock market. It's a forward-looking machine. It doesn't care as much about last quarter as it does about next quarter. The bull case is clear. The main business is humming along just fine. But the bear case, it's all about the future. The company's own forecast, their guidance, was for slightly slower growth next quarter than people were hoping for. It's like the market was expecting this perfect 5-star meal, and instead it got a really, really good 4-star meal. That tiny bit of disappointment is why the stock got hit. Okay, now let's talk about the risks, because you can't just look at the good stuff. There are 3 major challenges or headwinds facing Netflix that every single investor needs to be aware of. First up is something we call valuation. Basically, how expensive is the stock? Netflix trades at a price-to-earnings ratio of 42. Now, think of it this way. For every $1 of profit Netflix makes, investors are willing to pay $42 for a piece of it. That is a huge premium over its competitors. And when you pay a premium price like that, you're expecting perfection. Any little stumble gets punished, and that's exactly what we just saw. Second, the streaming wars are, well, they're more intense than ever. You've got giants like Disney and HBO who are serious competitors, all fighting for the same eyeballs. So to stay on top, Netflix is spending billions on super expensive content like the NFL and WWE. And on top of all that, they're raising prices, which, is always a risky move when there are other options out there. And the third headwind, and this one kind of came as a surprise, is a big leadership change. Reed Hastings, the guy who founded the company, the visionary who took it from mailing DVDs to a global streaming giant, is leaving the board. Now, they have a strong team in place, but whenever a legendary founder departs, it adds a layer of uncertainty. Okay, so we've talked a lot about the risks, the scary stuff, but let's flip the coin here, because the growth story for Netflix, this is where the long-term bull case gets really, really compelling. There are 3 massive engines that could drive this thing for years. And the biggest one, hands down, has to be advertising. I mean, think about it. Just a couple of years ago, Netflix had $0 in ad revenue. Zilch. Now, it's on track to hit $3 billion this year, and some analysts think it could get to $8 billion by 2030. This is a total game changer for their business model and a massive new fire hose of cash. The second growth driver is this really powerful 1-2 punch. First, live sports. That's a brilliant move because you can't skip the ads, which makes them super valuable to advertisers. You combine that with Netflix's proven track record of being able to raise prices without a ton of people leaving, plus the huge untapped markets in places like India and Latin America, well, that is a potent recipe for future growth. And here it is. This is the one number that really gets a long-term investor like me excited: free cash flow. This is the actual hard cash the business spits out after paying for everything. A few years back, this number was negative. In 2025, it was almost $9.5 billion. This cash is what lets them buy back their own stock and reward shareholders. Netflix has become an absolute cash-generating machine. Okay, so we've looked at the good, we've looked at the bad, we've weighed the risks and opportunities. Now it's time to do the math. Let's put this all together and try to figure out what the company is actually worth. To do that, we use a tool called a discounted cash flow model, or DCF. Now, that sounds complicated, I know, but the idea is actually pretty simple. All we're doing is estimating all the cash the company is going to generate for the rest of its life, and then we calculate what that big pile of future cash is worth in today's dollars. It gives us a sense of a company's true intrinsic value.
So, we ran 3 different scenarios. In our conservative bear case, where growth really slows down, we get a value of about $34 per share. In our base case, which is kind of our most likely scenario, we get a value of $64. And then in our optimistic bull case, where absolutely everything goes right, we land at $97 a share.
Now, look at this. The stock is currently trading right around $97 a share. So what does that tell us? It means the market is already pricing in our most optimistic, best-case scenario. It's assuming perfection. There is simply no room for error. So, after all that, what's the verdict? What does this mean for an investor? Taking everything we've looked at into account, here's my personal take on the stock today.
But first, full transparency. You need to know that I am already a Netflix shareholder. It makes up about 3.5% of my portfolio. So this isn't just some academic exercise for me. This is the real homework I'm doing on my own investment.
All right, so here's my verdict. I'm holding my position. I'm not selling. It's an excellent, dominant company with clear growth drivers for years to come. However, and this is a big however, I am not buying more at this price. The stock is simply priced for perfection. If the company only meets our reasonable base case expectations, the stock could fall by more than 30%. For me, the risk just isn't worth the reward right now.
And that really brings us to the final crucial takeaway from all this. You can love a company, you can be a happy customer, you can believe in its long-term future, but that doesn't automatically make it a great investment at any price. For Netflix today, the business is great, but the price demands perfection. And as an investor, I'm waiting for a better price before adding more.